Are you a scaling SaaS founder?
Ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those who don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where funding a company is like outfitting a ship. Every investment adds sales, supplies, and a fearless crew to set sail on the adventure of a lifetime. I'm your host, Jeff Maines. I hope you to be SaaS founders like you grow from traction to scale. Here, growth is more than just numbers. It's about crafting a future-proof company, premium valuation, and leaders who build a business of significance while living epic, adventurous lives. You want to hear something truly terrifying, like shining levels of scary? It's not that ghost in your office or the weird noise your coffee pot makes in the middle of the night. It's watching your company's cash burn, like Freddy Krueger slashing through your bank account in slow motion. I was talking to a founder last week who showed me his cash flow projections. Think less Field of Dreams and more Nightmare on Startup Street. Here's the thing about cash burn. It's like every horror movie villain, relentless, unstoppable, and they keep coming back, sequel after sequel after sequel. Kind of gets old after a while. But when it finally catches up, game over. But fear not, brave founders. Like any good horror movie survivor, I'm going to show you how to become your own final girl or guy, outsmarting the cash burning monster that is stalking your financial statements. First up, we want to make sure that we master the art of capital efficiency. Growth at all costs, which was so hot for so long, was out a couple of years ago, and capital efficient growth is in. So we want to master the art of capital efficiency. First up, channel your inner Ellen Ripley and get strategic. Your burn rate isn't just a number, it's a motion detector tracking the alien threat. And for many founders, the first place to look is CAC, customer acquisition cost. If you're spending $5,000 to acquire a customer that is worth $3,000, you're not running a business. You're starring in your own financial horror show. And spoiler alert, it doesn't end well. And you think that that doesn't really happen, but I see it all the time. And it's not because founders aren't smart. They're extremely smart, but they just don't know their numbers really well. They don't understand what goes in there. They don't understand how it's calculated. And they look at it and they go, wow, we're spending a lot more on this than it's worth. We've got to fix it, right? High CAC is a serial killer and the number one issue that I'm hearing right now from new SaaS founders that we work with. And one of the first things that we do is slay that monster together. And so we've got to drive costs out of that model, really understand where is CAC today, what is that acquisition cost, and how do we become more capital efficient? How do we spend less to get more revenue? Second is to accelerate your cash conversion cycle. Think about that. Speed is your friend. Think less Night of the Living Dead shuffle, and more like World War Z sprint. Annual contracts paid upfront aren't just nice to have. They're your silver bullets. What are some ways to accelerate the sales cycle or options that help you get to cash faster? Speed absolutely wins. Create urgency through value, not scarcity. Discount expirations, that's so 1999. But quantify the cost of inaction. So many deals are lost to, close, no action. I see this all the time. Like half the deals that end up in the pipeline, close, no action. Like, well, what happened? There wasn't enough pain. There wasn't enough reason to take that action because they really don't understand the cost of inaction. Or if they do, then the value that they're getting from taking that action is not enough to overcome that cost of inaction. But you show them that cost of inaction and budget will materialize out of thin air. I've seen it time and time and time again. The third one is to build multiple revenue streams. Diversify your revenue streams. I'm all about focus, and that will never change. You want to be laser focused on the target market and the value that we deliver, and then diversify revenue streams. So it's kind of like stocking up for the zombie apocalypse. Core product, but then we want add-ons. We want professional services. We want partner revenues. Each one of these is another weapon in your survival kit. Transform your product from lone survivor to a full arsenal of revenue generators. And that's one of the reasons why net dollar retention is so critical. Because when the world is going crazy outside, you can tap into revenue inside your existing base. And it's absolutely there when you can cross sell and upsell, when you have more to go back and sell those existing clients. But here's the plot twist: 82% of startups join the startup graveyard because of cash flow problems. 82%. I mean, 4 out of 5. It's crazy. And it's not because they were cursed with a bad product or because they ran out of runway faster than the friends in Final Destination. So here's your mission: brave founders, choose one of these survival strategies and implement it this week. Don't try to fight every monster at once. I mean, even the Avengers started with one battle at a time. But remember, in this spine tingling world of startups, cash isn't just king. It is the difference between being the hero of your story or, ending up on the cutting room floor. So head out there, fire up that revenue factory if you dare. Cue the John Carpenter soundtrack here. Our expert guest last week was Naomi Soman, storyteller extraordinaire. Well, that's such a great episode. Well, she works for SimilarWeb, where she writes all the copy for the PPC team. Naomi goes deep to capture stories that really matter and make a brand worth believing in. And we talked about how to make a compelling superhero origin story, why it matters, and then how to use your story to drive extraordinary performance. If you missed that, you've got to go back and listen to it. Naomi is so great. And our founder last Tuesday was Randy Wooten, CEO of Maxio. And he shared powerful insights from 20 years of scaling SaaS companies and driving strategic growth. We talked about Maxio's rebranding from the combination of SaaS Optics and Chargeify, mistakes founders make in finance and revenue, and boy, there are a lot of them. And this is the really cool part. We talked about the 2024 SaaS Performance Metrics Benchmark Report. If you want to know how you stack up against other companies in your market or in your size range, it's all there. Extremely valuable and free. I can't believe they don't charge for it. I'm glad that they don't, but it is free. We'll link it in the show notes again, and I'll edit this week also. So if you missed either of those episodes, go back and give them a listen. Absolute gold. My guest today is Brian Parks, founder and CEO of Bigfoot Capital. Bigfoot Capital is a firm that has provided $95 million in non-dilutive growth capital to SaaS companies looking to achieve healthy, autonomous growth. With decades of experience in financial services and also an exceptional SaaS operator, Brian has contributed to over $1 billion in enterprise value across 50 companies. He's here to share his unique insights on growth, resiliency, and guiding founders toward long-term success. Welcome, Brian Parks. Hey, Brian, welcome to SaaS Fuel.
Thank you, Jeff. Happy to be here.
Can you share a little bit about your journey from commercial lending and M&A investment banking to now founding Bigfoot Capital? What inspired you to create non-dilutive growth capital solution for SaaS?
Yeah, absolutely. So about the first 6 years of my career, kind of straight out of school until I was about 28, was like pure financial services. So you mentioned commercial lending at a bank. Did that for a couple of years, and then did about 4.5 years of M&A, investment banking. So predominantly helping sell companies, sell side M&A as it's called. We also did some buy side stuff, helping with acquisitions. But so it was a great kind of formation, early career experience for me. Gave me, I looked at a lot of companies. We helped achieve some really good outcomes for those businesses and the folks that started them. And none of that was within tech. So, I think predominantly what I learned there were, a few things. There was always some capital stack involved for those companies. 0% of them included venture capital. They weren't software companies. They were manufacturing companies. They were, product companies, services businesses, whatever they may be. And so, but maybe they'd raise some private equity or some angel and friends and family. Maybe they'd raise some bank debt or non-bank debt. Maybe there was some mezzanine debt in there. There's some capital structure that had helped them along the way to grow their businesses. And ultimately,
makes sense.
In the investment banking role, we were helping them realize, all the hard work, years, effort that they had put into it through an exit. So, and those were awesome outcomes to be a part of, that success. And we were only involved in it for, 6 to 12 months as the advisor, and so being able to help folks realize that value that they'd spent a significant portion of their lives building and committing to was awesome. And so I love those outcomes. I still love those outcomes. And then, I jumped into kind of operating roles at software companies in 2010. Really wanted to get operational experience rather than just advisory experience. And so I spent about 7 years doing that prior to forming Bigfoot in 2017. So Bigfoot's almost 8 years old. And so that was like pretty early stage software companies, a handful of them, one of which I started, which was an enterprise software company called Brandfolder. I directly and kind of indirectly through supporting in those companies raised capital. It happened to be all equity capital. It was angel and some venture money. And, it was a big shift from what I previously conveyed of doing M&A outside of tech into getting into this slightly different capital market. And it was cool and it was exciting and got to, work on a bunch of interesting stuff and, build companies, from the earliest stages. So, I spent time doing that. And, really what that led to in the formation of Bigfoot was like, hey, wait a second. Like, it's all equity. That's the only capital I raised for those types of software companies. A bunch of my peers, friends, colleagues, whatever, had the same experience. And it was like, well, why don't we slot in a different form of capital that's not just that? Doesn't just have those expectations in terms of the value they're trying to realize, 10x for equity investors, whatever it may be. Doesn't require a board seat, doesn't, come with control mechanisms that equity comes with. Like, let's bring a different capital product into this segment of companies that we really like and want to continue supporting and being involved with, that's not really there to a meaningful degree. So, there were a handful of folks doing it when we started, and venture debt as an asset class was a thing and had been a thing since, call it, the 80s. But that was really reserved for companies that were institutionally venture-backed, which was some small subset of the broader universe of software companies. So we started Bigfoot to say, all right, well, we're going to lend money to these companies and figure out a way to do that and help them grow and, generate enterprise value, like we were talking about right before we hopped on, and, be a growth capital provider. So that's what we've stuck to that knitting ever since. We've worked with 54 companies. 41 of them have repaid us in full successfully. We thankfully haven't lost any money off of lending, and, that's a good thing, right? So there haven't been some challenging situations that we mutually need to, collaborate on with our borrowers, portfolio companies over time. But like, generally speaking, things have worked out well and companies have been able to grow and generate enterprise value with this non-dilutive capital.
And those companies that have repaid, have those been through, bringing on other investors or, acquisitions or exits, or what does that look like?
Yeah, great question. So it's just, we track that data pretty closely. I was just kind of boning up on it, hopping onto this call. So 41 have repaid. 17 of those have been a result of an equity raise or a sale of the business. So, nice. Realizing that value, that equity value. So it's, I think only 5 of the 17 have been like true venture capital raises. So that happens, but we don't over-index to that. It's like, what we're trying to do with our capital is not box anyone into a corner of, you have to achieve this outcome for this to be successful, and it must look like this. It's like, no, it can, it can look like this, that, or the other, in terms of how you're going to go about building the business, right? You may decide to cash flow it. You may decide to, you may have the ability to raise a venture capital round. You may not. But you have the ability to get to a certain milestone and then raise a private equity round. You may find a strategic that's really interested in buying your company at whatever scale it's at. Like, you want to keep those options open to yourself. And that's what we want to try to foster. So I'd say, 17 have been repaid as a mechanism of an equity raise or a sale. Almost half of the repayments have been through another lender refinancing us, which is also important. So, there's folks that do something similar to what we do, and they may do it upmarket to include banks. So if we can help a company grow with our capital when they're not quite in the wheelhouse from a check size standpoint, or they don't have the equity sponsorship for a pure venture debt lender to be able to lend into them because they're going to look for that. Can we help play that role and get them there? And the answer is yes, we can. And we have, more than 20 times across those companies. So, and that's a big part of our job, honestly, is to try to know these companies very well while we work with them, have a broad ecosystem of other capital providers that's both equity and debt. And we can touch on the survey that I referenced earlier that we put out, and kind of be an enabler of liquidity. So we're providing liquidity, right? We're providing cash to grow that gives you more resources and liquidity on your balance sheet. gives you more runway, what have you. And then ultimately, we're trying to even help you get more liquidity, however that happens, right? Like we scale, we cap out at some point. Now we can grow from 1 to 2 to 3 to 5, but if it gets to a point where the company, needs something more meaningful than that, it's kind of a natural handoff. And so we understand that. Thus, we should be pretty good at knowing who all of those players are and pairing that with knowing the company and the profile of the company very well, so we can kind of match make.
That's so important, having that handoff. Super important. Well, I'm a big fan of the model, but if you could tell the listeners a little bit how Bigfoot Capital is different from traditional venture capital or private equity or even angel funding.
Yeah. So, pure debt is the first thing to say, right? So it is purely non-dilutive. So you're not selling us any of your equity. We are providing you a loan that is meant to be repaid with some interest, right? That's how we generate our return. And so that's pretty straightforward. And that can be in conjunction with equity. It can be in lieu of equity. It's not the case that we're saying, hey, great, go raise equity and then we'll, loan you some money. That is pretty pure play venture debt. That says, hey, great, you just raised $5 million. Here's, $1.5 million. Great, you just raised $10 million. Here's $3 million. They're going to think of it that way. Let's loan them kind of up to a third of the equity that they just raised. It's kind of interesting to hear this from founders. It's like, well, why do I need that? I just raised all this money that's giving me 18 months of runway. Why do I need to now tack on? And the answer is, well, you may be right. Maybe you don't need to draw on that right now. So I think it's important if you are considering that and have the ability to raise that debt capital, having some delayed draw concept. So like, great, I want the commitment. I want to know that it's there, but I don't want to take it right now. And some lenders may afford you that ability, especially if they're banks and they're getting your deposits. They have other ways of making money off of you rather than just lending you money. But yeah, I'd say, so we're different from equity in that we certainly don't dilute. It's just pure debt. And our expectations are different, right? So if we're providing a loan and it's a 3-year loan, we're looking for something like, 1.4 to 1.5x what we put in. So we loan you $1 million over 3 years. We're expecting to get back $1.5 million. So we get our $1 million back and we get an incremental $500K of, profit, let's just say through interest. So the math there is, okay, let's both believe that you can generate more than that, right? Can you generate 2.5x off of that money? If so, it's accretive. It's immediately accretive. It makes sense. Hopefully you can generate more than that. And I think back to that sampling of companies that have, paid us off as a result of an equity raise or an exit. What we've seen is they've, increased their enterprise value from when we funded them to when they paid us off via that equity raise or an exit by 57%. Right. So on average, if you kind of look at it, that was an increase of like, $8 million of enterprise value. If we're providing them, $1 million loan, they kind of 8x'd it. It's like that's really good, or 5x'd it, whatever it may be. Something really good value that they got off of that capital. So that's the way I think we want founders to try to think about it, right? If you don't think you can generate value off of this capital, we probably shouldn't do it. And there is risk with any capital that you take. There's risk with debt. It's meant to be paid back. How are you going to do that? There's risk with equity as well. It's meant to,
absolutely,
generate meaningful value for the equity investor. If that's not happening, there's probably not more equity to be had for you. Or if there is, it's going to be relatively painful, right? If you haven't really grown that valuation. Or if the board could say, well, you're out. You're clearly not generating value. So we're going to plug someone else in here. Or we're going to try to harness value ourselves. We're going to run a process to sell the company. There's certain things that can happen. So.
Yeah. I think that those are really good considerations to think about. Now, I love the idea of driving enterprise value, and that's got to be the foundation, whether it's debt, whether it's equity. Ultimately, that's the goal. And then if you think you're going to drive that enterprise value, if you believe that, how much of that equity do you want? And the answer has got to be all of it, as much as possible. I don't want to give that away if that's where the real payday is in driving that enterprise value and then realizing that, along the journey or maybe, at the end through an exit, but it's holding on to that for as long as possible while that enterprise value goes up.
I think that's right, Jeff. I think two things. So we're not wholly against dilution. Like we don't dilute people, but we understand that there may be times within a company's path to take dilution, right? Like, okay, fine. Yeah. But what we are, kind of fundamentally against is like being frivolous with your equity. And I think that's the trap that a lot of folks get caught up in.
All the time. It's sad.
It's just you get on this wheel of, and it's sexy to raise equity. It's like, well, wait a second. Before you know it, we see this, unfortunately, all too often when we see cap tables, right? It's like, ooh, wow, how do they only own that much at this stage of the company? Like, that's really unfortunate. Yeah. And so we want to try to have that not be the case. So like we're just pushed against, frivolity with equity, which I think, unfortunately in frothy equity capital markets, or with, overdue influence on Twitter or TechCrunch or VC sitting on high, like people just kind of get caught up on that. I think even instruments like convertible notes and safes make it even easier to get caught up on that. You kind of don't think or feel that you're taking dilution, but you are, and ultimately you certainly will be. And so it's just kind of these products have been introduced that, it's going to it makes it easier. You don't have to put a price tag on this thing if it's an uncapped note or safe or whatever it may be, and it kind of makes people not think about that stuff and push it to the side when they really shouldn't be thinking that way. Those are dilutive instruments.
No, without a doubt.
With equity return expectations.
Yeah. Yeah, and the longer you can delay that, and all of them are vehicles that can certainly be used, and there's a right time and a place for them.
That's right.
But making sure to really understand that, because it is. You look at the cap tables, and even a company, maybe they have a liquidity event, and they sell the company for $50 million, and you look, and the founders walked away with $5 million. Yeah. It's like, wow. Yeah, that's really hard to swallow. Do you think some of that is because just that the nature of the business, founders don't have the financial expertise that the people they're negotiating with do?
Yeah, I think that's a big aspect of it, right? And I think that's, I feel personally fortunate to have grown up professionally outside of tech. Obviously I'm kind of a studied finance, worked in finance. Yeah. Like I bring a finance bent to it. A lot of folks don't have that experience, right? So maybe they're product people, they're engineering people, they're sales marketing people, but they're not necessarily finance people, and they don't like to think about finance. So, I behoove people to try to think about finance or get people in their orbit or on their team who are thinking about it that way. So I think, yes, part of that's just kind of a lack of that experience or acumen. Part of it is, I don't know, just influence, being influenced by getting caught up in the hype of, everyone else is doing this, right. And, it's almost FOMO. I should be doing that. Right. And not only should I be doing that, but, oh gosh, if I, am actually able to achieve that, that's a huge marker of success. And I'm not actually thinking about the other side of that trade, because it is a trade, right? Like, we're making trades here. I'm giving you money to get paid back and make some interest. Someone else is giving you money on the equity side to 10x that, right? You're taking dilution as a result there. So I just think it's important to, for operators to consider all of those factors and, hey, what am I trying to build here? Again, think of enterprise value. Hey, am I trying to IPO this thing and make it enormous? Am I more of the nature where, hey, like it'd be great if I could sell this thing for $30 to $50 million. By the way, like the median exit value, if you look at M&A comps for software companies, is like $69 million, which, if you own a meaningful part of a company, is a lot of money.
Yes.
But I think if that company were funded with $20 million of venture capital, that's not a good outcome that's generally not a good outcome. Right. It may not even be an achievable outcome. Like the board and the VCs may be like, no, we don't want that outcome.
I've seen that happen.
Right.
Great deals for the founders that they're like, yes, this is life changing. This is awesome. And they're like, it's a 3x return. We're not ready. No. Totally. And they stand in the way, and it's like,
sometimes it doesn't. So again, it's kind of like, what are you trying to build? What game are you playing? I mean, either form of capital, any form of capital is just a tool to try to enable you to, continue along, on some path. And I think what's also important is that path you want that path to be able to change. It can be very hard to get off a path once you're on it, right? And I think the venture path can be hard to get on without taking a lot of medicines. We see a lot of companies now that we're on some venture path, we're not the only ones that see this. but growth is degraded, what have you. They had valuation here and they're not raising at that valuation anymore. That's not happening. Or if they are, there's a lot of structure on the deal, liquidation preferences, what have you. So, you got to recap the company, you got to take a big down round, you got to do whatever, or the common, which is where the founders and the employees sit, is just buried beneath a pref stack. That is hard to clear in an exit scenario. Which even if you can achieve an exit there and it looks good in the headlines and what have you, it's like, back to your point, like the common walked away with nothing. And the preferred may have not even recouped 100% of their investment. So it's just, I just want everyone to be cognizant of those things, right? So again, it's kind of like, I would like, 20 to $70 million exits to be highly celebrated, right? Like I want to see a lot of those. I think those are, and they're way more feasible and achievable than, 9-figure exits. They just are. There's only so many, companies, financial firms out there that can write checks that big to take down that size of exit. Like I call that your total acquirable market. Like it shrinks as you raise more money and thus you have to generate a bigger exit. Like it just fundamentally does. So again, be cognizant of that and understand that there's going to be a lot more exit optionality for you at smaller dollar numbers. Thus, if that is fundamentally the case in the market, it's pretty important that you don't overcapitalize the company and make that unachievable, and that you retain the equity such that your percentage times that ultimate number is a good number for you.
Yeah. I think for whatever reason, equity seems like it's kind of the way to go. It's the cool way. And then you bring in that big scary word called debt. Yeah. And the founders, it's kind of scary. And it's like, I don't know about that. I don't understand. It's paying it back, where equity I don't have to pay back. No, you pay up front for equity. But how should they be thinking about debt and maybe reframe that as a real financial tool?
Yeah, I say this, totally agree. Debt's literally a 4-letter word, right? And there is a connotation around it. Now, I'd say it is a financial instrument that's been around for millennia, right? And is very broad in terms of how it's deployed. And is orders of magnitude larger than the equity capital markets. Like the credit markets are much larger. Now, I just think it's nuanced to a degree that it is a newer concept to a lot of folks within tech, right? It has been a very equity driven market, right? And it's still a very, I talk with a bunch of folks out there that deploy capital to, very broadly. And what we do is fairly still viewed as niched and nuanced and crazy by many. Like you're going to lend money to software companies that don't have any assets and don't really have cash flow, generally speaking. Like, what? It's hard for traditional finance people that are smart and they manage a ton of money to wrap their heads around that. They're just like, we'll go lend against real estate or equipment or middle market cash flowing companies. So what I would say is that debt is broadly used across a multitude of industries on a very large basis to help fund companies from a working capital standpoint and from a growth capital standpoint. So let's just all know that. And be like, a lot of companies have success using that in their capital structure. If you look at the NASDAQ, it's like 1-to-1 debt to equity. So the capital structure of the most successful, valuable software companies are 1-to-1 debt to equity. And I'm not saying it should be that for companies that are nowhere near that in their life cycle, right? But having some moderate amount of debt in your capital structure, it just makes sense oftentimes. Now, I think what you have to do is say, okay, like for us, we're not going to lend money to a company that has less than $2 million of revenue. We're just not going to do that. That's too early for us. I mean, their minimum check is, call it $750K. We may stretch down to $500K. So I think you just have to be really aware of that. Don't borrow too early and don't borrow too much. I think that's another thing that folks get caught up is, someone's going to give me more. It's like, do you really need more? Were we even talking about you getting more? Like, you got to step back and try to model that and understand more is not always better in any capacity, equity or debt. Right. And so I think much like you can take on too high of a valuation and too much capital on equity, you can take on too much debt. And then guess what? If things don't work out, you're over levered. And thus, it can be hard to get out of that situation. And there's a lot of companies that are in that situation right now.
Yeah.
So I think it's really just being moderate with it, understanding that it should occupy some percentage of your capital structure, and then really trying to understand the benefit that you're generating from it, which we previously discussed, right? In terms of growing enterprise value, not taking dilution, and not having kind of the control dynamics that may come along as well in some equity deals.
Yeah. It's a really good way to think about it. And for most people, one of the biggest purchases they'll ever make is buying a house. And if you're doing that, you're going to go get a mortgage. Most everybody does. And if you go in and you ask the mortgage broker, how much house can I afford? The number that they give you is a lot of times astronomical. And you look at that, and people will go in and say, okay, I can spend this much, and they'll go push that to the limit, and then it doesn't really fit their budget, or they can set a budget and say, here's what we're going to do, here's what we can spend, here are our parameters, and then they go and do that. And the same thing happens in debt here. Just because someone will give you a loan for a certain amount doesn't necessarily mean that that's the right amount, or you should take it, or that you can pay it back. So it's really having that model for yourself.
Yeah, and you can kind of do test runs on it too, right? I mean, you can borrow at lower amounts. Even with us on a facility, maybe it's a $5 million top line company, and we say, hey, here's a $2.5 million facility. Maybe you don't need $2.5 million right now. Maybe you take $1 million of debt relative to $5 million in revenue is reasonable, even if you're not cash flowing right then. It's reasonable, and part of the reason it's reasonable is, honestly, look, even in a downside scenario, like, you can pay off that debt somehow, some way. Like, that's what we've seen, right? No one should over rely, including ourselves, or over index to that. But, if you think about software companies at $5 million of revenue that aren't complete dumpster fires with negative revenue growth and terrible retention and what have you, there's some harnessable enterprise value there that someone else will lend against, or someone will, fund equity into or buy, right? Yeah. Not to say raising money is ever easy, but that's what we've seen. The worst outcome we've ever seen for a company that we've lent to in terms of harnessing enterprise value was a 1x multiple on revenue. And that's a pretty distressed situation. So, from our own standpoint, if we're lending at, a third to a half of revenue, there's a lot of coverage and buffer there, right? Now, if we were lending at 1x revenue or 1.5 or 2x revenue, that starts to get a little over levered.
Yeah.
So anyways, I think that's that's an important concept to consider. So it's, I'd say don't get drunk on any type of capital, right? Be moderate, with it. And then really think about the mix of capital that you may have available to you within your capital structure. So, back to the NASDAQ, it's kind of 1-to-1. Okay. Should it be that? Don't know. Maybe not, but should it be 0.3-to-1? Doesn't necessarily need to be 100% either which way. Maybe that's not the healthiest balance. Right. So, and I think the last thing I would say is, everyone tends, and I get why, everyone tends to think in terms of cost when it comes to debt. What does it cost me? It's just pure, the conversation goes there so quickly. That's fine. I have nothing to hide. Happy to have that conversation. But people kind of don't think that way with equity. Yeah, we think in terms of valuation,
right?
But we just don't that's not where the conversation goes super quickly. So I encourage people to not be overly myopic on the cost. Again, we used the example earlier. Hey, if you got to pay us 1.4 to 1.5 on our investment over 3 years, but you generate 2.5, 3, 4, 5, 6, 7, that's a pretty good trade for you. It's a good trade for us.
Yes.
It's a good trade for you. Equity capital is more expensive than debt capital.
Without a doubt.
It just is, right? And I think, we generally don't want to partner up with people that don't believe in the value of their equity. That gets back to being frivolous with your equity. It's do we both believe that, you're creating value here and, you're really bullish on your equity value? Great. Let's help you retain that. And so with debt, you can actually blend down your total cost of capital, right? You're kind of, modeling what the equity cost of capital is, you're modeling what the debt cost of capital is, and you're blending it down to something that is less than just a pure equity funded capital structure. That gets into finance stuff, but yeah, it's kind of a grown up capital structure.
Ready to future-proof your company and scale to new heights? Dive into the ultimate resource designed for SaaS founders and C-suite executives. Champion Leadership Group gives you an unfair advantage in scaling up revenue and outwitting competitors. Imagine solving your biggest scaling headaches and hitting 5, 10, 20 million ARR and beyond with ease. We take away the guesswork and the grunt work and replace it with framework by supporting you with our on-demand fractional C-suite team, a powerful operating system built into software, and a thriving community of fellow scaling founders. That's how we make it happen. So if you're stuck at your current revenue level, this is your ticket out. Feel like your company is the world's best kept secret? We amplify your success. And hey, if you're already crushing it but too busy to breathe, we got your back. We'll free up 20% of your time in the first month. Now is the time to upgrade from traction to scale. If you're ready to work smarter and not just grind harder, schedule a 10-minute growth brainstorm. It's free, and we'll pinpoint the number one thing blocking revenue. Visit championleadership.com. That is where leaders evolve and companies transform. It is. And well, some founders, will look at the debt, like you said, 4-letter word. Something else that I've seen is sometimes there is an equity round, and it could be venture capital, it could be private equity, but they make the investment and then they go put debt on the business. Mm-hmm. And it's one of those things like, why didn't the ownership team look at that as an option to start with?
Yeah.
And hang on to some of that equity.
Yeah. Yeah. Right. And I think that, that would be a pure kind of venture debt raise. Right. And it's interesting. Yeah. Some venture capitalists are very pro venture debt. Some are very anti. And so debt is like, kind of a personal level thing, right? Of like, oh God, I just hate, my dad. He's the guy that, if he has the ability to, doesn't want to have a mortgage. I'm someone who says, I've got a mortgage at 3%. Like, my wife is like, can we just pay off our mortgage? I'm like, well, like, I don't even know if we could, but if we could, it doesn't really make sense. And here's why. But she's not a finance person, and she's just like, I don't want a mortgage payment. But it's, sure. So I think it comes down to a very even personal and experiential, Paul Graham, for instance, who's a very successful equity investor, is seemingly very vehemently against debt. At least from his tweets. I've seen it a number of times. And it's kind of like, all right, Paul, like, you've got a lot of influence over people. It's a little bit of a broad statement to make that, like, oh, it's just terrible. And it's like, yeah, maybe you had a couple of situations in your investing career where things didn't, like, that can happen, right? Like, any capital ultimately is going to try to protect its interest in some capacity if things have just gone terribly wrong. Like, I think that's pretty factually accurate, on behalf of their own investors. That is my fiduciary duty, managing other people's money. That's any, venture capitalist fiduciary duty on behalf of their LPs. So I think just making kind of those broad statements that, again, people see that and they're like, oh my God, with no practical experience around it it's kind of unfortunate. So, I mean, look, I think we have certain operators in our portfolio that have been there, done that to some degree, even if they're first time borrowers. But then once they start utilizing debt capital, they're like, shoot, I wish I had done this previously for other companies I've been involved with, or like, why doesn't everyone do this?
Right.
Not to say we don't have the folks that after a period of time are like, I don't really want this anymore. And that's where it's important that we don't over lever you. It's like, okay, fine. Like, get it. For whatever reason, you don't want this anymore, and they have been able to, remove us, let's just say. And that's fine. Right. But others may work with us for 4 or 5 years. Right. And really be driving enterprise value. So, and look, we don't want to force ourselves on people. No one should have capital forced upon them. So you got to be comfortable with whatever whatever situation you're getting into.
Sure. Yeah, it is interesting that a lot of the other industries, this is kind of the norm. Is debt has been an instrument in those industries for decades, but in software, it's not used nearly as much. Do you think attitudes are different between Silicon Valley and other regions, or software industry and kind of other industries?
Yes and yes. I think from an industry standpoint, I really think yes is the short answer, because I just don't. I'm hard pressed to think of other industries in the broader economy, even where massive private equity plays big roles, where there's so much influence from those people as there is from venture capitalists in tech. They just have done a very good job of marketing themselves. And they're smart people that have been successful, and a lot of people look up to, and that's fine. But that influence just, and you probably have younger operators in tech oftentimes. It tends to be the case that the folks that we partner up with are a little bit older. I don't mean to be age biased, but it's kind of like, we're generally not working with the 22-year-olds out of the dorm room in Stanford, right? Like, for whatever reason, we're just not. We may be working with a 45-year-old out of Tulsa, whatever it may be, building a software company. And so that person's building a software company, and they may have grown up outside of software and then, gotten into it and built a solution for some, other industry of which they were a part earlier. Like, they've just got a fundamentally different professional experience than someone who, is a CS grad who's super smart and can, write a lot of code, do whatever. That is kind of that profile of founder. And they're living in a different geography than maybe that person is, where the equity capital market and availability is fundamentally different. And the expectations of that equity capital is fundamentally different. So there's a lot of nuances there in terms of both industry, geography, and culture that come into play in terms of how folks may think about this. And I still think we've been doing this for 8 years under the Bigfoot banner. It's still early innings in my book of like, there's still so much education to be done. There's still so much lack of awareness. There's still so much like fear and bias. And, part of me feels like, man, like how have I not, like, how do we not get this by now? But it's just whatever, you got to continue educating and, finding the right matches, right? And really just helping people understand and telling people when it makes sense not to take debt. No, it's too early. No, it doesn't really make sense. No, you don't have the predictability. No, you don't have the margin profile, whatever it may be. But also helping them understand that on the equity front, holistically on the capital, like strategy front is what we try to do.
Yeah. We've seen a fundamental shift in SaaS over the last couple of years. Growth at all costs, which was the model for a long time, and now capital efficient growth. What do you think about that, and just the mentality and alternative approaches? Are there positives, negatives to that, and what do you see in the capital markets related to that?
Yeah, thanks for asking that. Very little appetite for growth at all costs, at least from the folks we interact with in the capital markets. Very little appetite for that, and I think. But that said, we just put out a survey, and I think you can share it with folks. Whenever we publish this, it's just like, an open Google Slides presentation. So, of 50 plus kind of equity and debt investors that focus on B2B software. And, hey, what metrics matter were one of the question. For both, revenue growth still number one, followed by burn multiple. We kind of gave them a list of metrics. Burn multiple, which is capital efficiency alongside that growth, followed by retention, net and then gross, and then followed by rule of 40. So people still want growth. Growth is still what is the predominant driver of enterprise valuation for software companies. That's still the case. But it can't be at all costs. It can't be a negative gross margin. It can't be a terrible CAC that, you can't just hope and pray, which has happened for many years. Sure. That all that stuff's going to figure itself out, and growth is the panacea for all of that. Back to Paul Graham, not to bash Paul Graham. I have nothing against Paul Graham, but his definition of a startup is an organization that's designed to grow fast. That's the definition of a startup, and that's fine. And that squarely puts the North Star on growth, which again may be fine. And as I just conveyed, that is the number one factor for folks making capital investment decisions, growth. But I don't think growth necessarily needs to be the North Star 100% of the time. I think you have to be flexible within your company to shift, right? Like, don't focus on growth if the retention's not there. If the unit economics of the CAC that you're deploying don't make sense, that doesn't make sense. Like, and that gets back to like, there was a whole generation of companies, some of which have ultimately been able to be very successful, say when the IPO window was open, that did that and got to enough scale and had enough interest, and it was fine and it worked, right? Uber, Airbnb, whomever that maybe didn't have the unit economics dialed in. That doesn't really play anymore. That playbook doesn't play anymore. right?
Yeah.
So I think we all have to recognize that and build, and think about health, right? And so I think one of the benefits of this comes back to fear as well. In my view, one of the benefits of debt is it does drive discipline, drives operational discipline. You have to be able to service your debt. And so if you need to be able to do that, you have to think about your business and think about, how you're going to orient your business holistically to be able to, you've added another fixed cost, right? Which is one way of thinking about it. It's kind of like, oh, okay, if I take $1 million and it's at, 15%, I'm paying, let's just say this, $1 million, you're paying interest only for the first 12 months. It's at 15%. You're paying $12,500 a month on that $1 million for that first 12 months. Maybe that's one or two junior engineers, depending on model that in basically and decide where you have to. And if your growth plan, hopefully you can just grow and that works. But if you can't, you just got to really diagnose and think about your business and operate with discipline. And so I think it's a good thing on the whole of how things have shifted over the past few years. I think it just gives you make for a much healthier universe of businesses. In the long term. Now, I still think that reorientation is hard. I get that. It's hard for everyone. There's a lot of medicine to be taken. There's a lot of people that maybe didn't sign up for that, to include the VCs that funded those companies, right? And that can be fine. But, yeah, man. I mean, I just think in terms of having an industry and a sector that is healthy, there are no other industries or sectors. We're just burning capital and subsidizing that, until, hopefully you IPO, is an accepted norm.
Right. Fundamentals actually do matter. And I think that's been a really healthy shift.
Yeah, it's interesting. It's I talk to some software companies, everyone's trying to get to break even and profitability and cash flow. And that's wonderful. And some are getting there and some are still on their path there. And by the way, we can help fund the path there. But some are I'm break even or cash flow. I don't need any money now. It's do you understand? Why would I take debt if I'm already cash flow break even or cash flow positive? I guess it's a fair question. Yeah, maybe you don't need any external capital and that's totally fine. But also recognize that you literally cannot get debt or oftentimes even equity in other capital markets without having cash flow. Right. So, many a private equity firm will not invest in you unless you have $5 to $10 million of EBITDA. Many a lender, bank or non-bank, will not lend to you unless you have that same amount of EBITDA. So just because you're generating $3,000 of EBITDA a month right now doesn't mean that it's it's just this interesting thing. Why would I need that now that it's because you're still trying to grow. And even if you are you don't really have the reserves, to do much beyond what you're doing right now. So I just think I don't know, man. There's a lot of thinking to be done around all of it. So I think conversations like this are good and hopefully informative for people. I'm always happy to hop on with whomever to talk about this stuff because I do think it's super important and ultimately, hopefully, healthy for their overall kind of ecosystem, so to speak, of software companies and founders.
Without a doubt. Well, you mentioned a minute ago the B2B software capital provider survey. So this is the third one you've done. This is 2024. So looking at capital markets now, which I think is really interesting. It should be interesting for everybody. Yeah. We'll make that available in the show notes. But what were some of the big aha moments that came out of that survey?
There's so much data in there. What I need to do is synthesize it a little bit better. So one of the things I touched on, which is, a slide I'm looking at right now as we talk, is that, what metrics matter. So it was somewhat, validated. Yeah, growth really still matters, right? But burn multiple is very close to that as the second order of concern. So, burn multiple is going to be, how much did you burn relative to how much net new ARR you added, right? You want it to be below 1. So you want to add more net new ARR than you burn. That's really good and healthy. That's below 2x. It's probably still pretty good and fundable. If it's above that, it's kind of indicative that, well, you're really just buying growth that maybe isn't that healthy. So, it just gets back to the validation around kind of, hey, you can't just have growth at all costs and everyone thinks that's going to work out. That doesn't fly anymore. So there's that. I think, look, there's still a lot of dry powder to be deployed. I think it's what was it? Let me just quote the stat. Kind of in our sampling of 50 something, it's 2/3 of equity investors are less than 50% deployed on their fund, and pretty much the same for lenders. So and they're eager. We're in the capital deployment business. We are all eager to deploy capital. But I think, folks, and the capital is there to deploy. But expectations have shifted, in terms of what is fundable. And it comes back to health, right? It comes back to, hey, we want to fund companies that have, healthy dynamics to them, right? So we still want to be excited about the opportunity and the growth, but can't just be all that for most, right? And then you kind of take, for most. But that's not everyone. You may have, Sand Hill Road VC, everyone's excited about AI, and that gets a hall pass. That is, all right, so new. There's so much opportunity there. There's so much growth. There's also FOMO from a capital deployment standpoint. So put that off to the side. The steady course, normal state, B2B software and SaaS companies, you got to have the health. If you do, and you're growing nicely, of course you got to have defensibility around the product. You got to have all the qualitative aspects of the business beyond the fundamentals. But there's capital eager to be deployed, and it's available. It's there. So I think it's still this. We've all been hearing the dry powder story for at least 2 years now, 2.5 years. It's kind of still on the sidelines. I think activity has picked up some kind of, so we asked, how active were you, first half of the year versus first half of last year? How active do you anticipate being next 12 months, right? Everyone anticipates being much more active, 80% of AB growth equity investors more active, 55% of seed A more active, debt, likewise, 2/3 more active. So but we also kind of saw that 12 months ago. Just they expect and they want, again, they're in the business of deploying capital. We shall see if that actually happens. And it only happens if the investable opportunities are there. So, assuming we don't go into a recession and inflation is tamed and we, interest rates come down, that should unlock stuff, right? B2B software spend, SaaS spend continues to grow, cloud spend continues to grow, right? But, growth is still quite challenged. And I think there's some recalibration there that still needs to happen. It's great to say you want, we only invest in stuff that's growing 75%, right? It's well, okay. That's just very slim, right?
That's really narrow,
You look at all the data out there, you look at the medians, you ask them how their portfolio companies are growing, and maybe it's 15 to 30%. And I get that. You don't want to step into that because you understand growth degrades. So if you're coming in at 75%, growing above that, wonderful. But oftentimes it degrades, and there's the Mendoza line, and there's all that stuff. But so yeah, man, I don't know. I need to do a better job of digesting what's in this 50 deck slide. It's a little bit
there's a lot in there.
Forest from the trees. But yeah, so there is some optimism with prudence, I think.
Yeah.
Because investors got drunk too. All of that. Like I was saying earlier, don't get drunk on capital options or capital structure. We all get it. It was a big party and everyone got a little bit drunk, and then everyone got kind of, the hangover and
morning after. Yeah.
Totally. And it's been a long morning after, I would say. And so I think everyone is still waiting to come out of that morning after and have some things to cheer on and feel good about. But deals are still getting done. I think in our own, again, I look to our own portfolio, you try to, all right, there's the macro and here's the micro, and so we have a sampling of the micro. And, if we have loans getting repaid, again, that's happening some way. And so even where we operate in kind of sub $10 million top line businesses, capital continues to flow, right? Deals continue to get done. I'm not going to say that maybe they aren't the valuations they would have been at 2 to 3 years ago. Maybe they don't happen as quickly as they did 2 to 3 years ago. But maybe neither of those things is on the whole bad, right? It's a reversion to more normalcy. So, but it's not like everything's not totally locked up. We see it. It's just, so I think, take some solace from that maybe.
Yeah. We'll definitely make the report available to listeners. It would be in the show notes. Yeah, and I think the good news is that capital is available, but there has been a little bit of a reset for founders and CEOs as well, and just how they run the business, how they manage, and pulling back from that whole idea of spend, and actually give it a little bit more thought, be a little bit more prudent in how you're doing that. Make sure there's an ROI faster, which is not necessarily a bad thing.
No, yeah, not at all.
But it is different.
I mean, yeah, it is different, and I just think that's a really good thing, right? I think just take a breath, and like these things take time. Generally when we come into a company, it's been around probably at least 4 years. It just because again, kind of $2 million is top line is where we're going to enter, and that just generally takes some time. Even to get to 2 million in 4 years is pretty damn good, right?
Yeah.
To get to 5 million in 7 years is good. Depending upon how you capitalize that. It's not good if you raise $30 to $50 million to get there necessarily, at least in my view. But yeah, take some time, right? I mean, I remember, look, the company I started, Brandfolder, which ultimately ended up having a really good exit at a really good time and didn't raise a ton of money, thus was able to have that exit, which was a 9-figure exit. Like, it worked really well. The math worked, and proceeds flowed down to literally everybody, which was great. That took time, so it took close to 10 years, right? And, thankfully the company wasn't oversubsidized with capital. But like I raised money initially for that pre-product, which the clock was ticking is what I would say. Like I would never do that again personally. I think it's for a certain type of person and founder, but when you take capital, the clock is ticking. So it can turn, and it's always a balance of sprinting versus kind of taking the long view of a marathon. Like you have to execute with speed, of course, but you're in a pressure cooker, a different level of pressure cooker when when you take some capital that has expectations, especially if you do it that early, right? Where you're just not even close to product market fit. So that was a fun couple of years there. But yeah, so again, kind of at the end of it, I just want people to try to be as informed as they can be, and understand the breadth of options available to them, because there truly are a breadth of options at different stages of the company in different forms, that I think there's just a big lack of awareness around. So.
And I think that's really the key word is options. None of these are inherently good or inherently bad. It's just having options and choosing the right tool for the job. Yeah. And that makes building a whole lot easier when you have the right tools at the right time.
Yeah. And it's just none of it's a panacea, right? It's not like capital doesn't solve problems necessarily. It helps you get resources to address problems. Right? Oh, I couldn't build that thing because I didn't have those 2 engineers because I couldn't fund them. Okay, great. Now I have some stuff that I can get 2 engineers and build that thing. But does the market actually want that thing? Can I actually sell that thing? Like, let's not view it, which is why I think, I'm not anti kind of ringing the bell and celebrating something that can be a company milestone of, raising some money. Sure. Like that's fine. I just think that has become too much of a hallmark of success, right? Yeah. Like you haven't really realized it yet. You've exchanged some equity that you held to someone else, but that is like the limited market for that equity. You haven't, you haven't truly realized the value yet. That's ultimately what you're trying to do. What we're all trying to do in whatever form.
Enterprise value. That's the key.
Enterprise value. So just swapping it around and jiggering a cap table is like not really what it's all about. But I think a lot of us, gotten way too caught up in that.
Yeah. Well, where can people learn more about you and about Bigfoot Capital online?
Yeah, bigfootcap.com. I'm on LinkedIn, Brian Parks, CFA. I've got a newsletter at bigfootcapital.substack.com, which you should be able to access through our website as well. Don't really do anything on Twitter. So that's pretty much it, man. The website, LinkedIn, and the newsletter.
Excellent. We'll link all of that in the show notes as well. And I have to ask the final question, where did Bigfoot come from? It's a great name.
Yeah, thanks. Kind of a bad pun. I'm not even sure if it is a pun. So one of the first financings we did in this space, was actually predated Bigfoot, was an acquisition financing. So it was one SaaS company buying another. So we called it a SaaS acquisition. We're out here in Colorado.
I
So
like
it was, kind of went through a naming exercise once we did decide to start what became Bigfoot. And it was, Sasquatch. And we're driving through the mountains. And it was like, Bigfoot's a better name than Sasquatch. And that was kind of it. Bigfoot Capital. Then it was, okay, expand your footprint. Capital shouldn't be elusive or mysterious, right? Which again comes back to like the education and transparency piece. So, so it's worked out well. It was not the most serious naming exercise ever conducted, but it's close to the beginning of the alphabet and it's memorable. So.
Excellent. SaaSquisition. Got to trademark that one.
SaaSquisition. Yeah.
Well, thanks for being on SaaS Fuel. It was a fantastic discussion. Really appreciate it.
Yeah, likewise. Thanks, Jeff.
Thanks again, Brian, for coming on the show and sharing your journey and insights. You can learn more about Brian and Bigfoot Capital at bigfootcap.com. As always, all links, highlights, resources, and full show notes are available at saasfuel.com. And be sure to check us out on YouTube as well. It's at Champion Leadership. We have full episodes, video shorts, training, outtakes, and quite a bit more on there. And thought leaders share. Share this episode with the person you know who is most likely to go out searching for the real Bigfoot. Everyone who shares this week gets a low battery vampire costume. Wear classic vampire attire, but with a 5% battery symbol on your chest. Yawn dramatically and fall into sleep mode every few minutes, only recharging when someone hands you candy. There you go. Well, join us next Thursday on our SaaS Fuel Expert Series where we have Andy Culligan, fractional CMO. Andy turns marketing into a revenue machine. And we'll be talking about the difference between brand building and demand generation, scalable marketing strategies that are working now, and aligning marketing and sales. Really cool stuff. Join us next Tuesday where our founder is Kamal Maheshwari, co-founder of D-Cube and a 28-year veteran in the data space. He'll share insights from his journey at Oracle, Cloudera, and more leading up to building the first unified data trust platform. I will see you next time, and as always, enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at saasfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSfuel. We'll be sure to read these out on future episodes.